Hello there. I'm Windermere Real Estate's Chief Economist, Matthew Gardner, and welcome to this week's episode of Mondays with Matthew. Today, I'm not going to discuss last week's economic announcements, mainly because there really weren't any that were of great interest. But instead, I'm going to cover a topic that was brought to my attention by two of my viewers, Lisa Peterson and Steve Jones, who reached out to me separately and asked if I would give an update on mortgage forbearance. And they asked me this in light of some recent headlines that are, shall we say, pretty frightening. Well, I think that it's absolutely worthwhile revisiting. So thank you, Lisa. Thank you, Steve. Forbearance is this week's topic. Okay, I mentioned that there are some recent headlines that were somewhat scary, and here are just a few examples. Now, this first one, well, it actually made me chuckle. As you can see on the left, it says, FHA mortgage delinquencies hit a record high with economy rattled. Oh no. But hold on just a second, what's that on the right? Low rates push home builders' optimism to highest since 1998. Okay, even I'm confused. Which is it? Well, here is my friend Diane Olick from CNBC, and she's clearly waxing poetic about the horror of there being 3.9 million homeowners in COVID-19 mortgage bailout. All right, this one actually really does tick me off. There is no bailout. You see, I grabbed a copy of Webster's and looked up the word bailout, and it's described as follows. A bailout is, and I quote, an act of giving financial assistance to a failing business or economy to save it from collapse, unquote. Well, of course, there will be some people who'll take this and think that homeowners are getting something for nothing, but that's not the case. You see, the FHA started the forbearance program back in March to assist homeowners who had been put into financial distress, by the way, through no fault of their own, and allow them to defer mortgage payments because of COVID-19 and mainly COVID-19 related job losses. Now let's get one thing straight. They aren't getting something for nothing. The payments that they miss must be made up when they come out of the program, and they can do this through refinancing possibly, and more likely given where rates are today, or they can increase their monthly payment to make up the deficit, or finally they could sell their home to satisfy the debt. But the way she says it actually sounds as if homeowners are having their mortgages paid for them, which is absolutely incorrect. Now finally, this is a headline from the New York Times, and this one's interesting because the article, well, it actually starts out by saying that overall delinquency numbers are improving, but the delinquency rate for homeowners who are seriously behind in their payments, well, that is soaring. Well, the problem here is, well, it's rather simple. The delinquency numbers, well, they include owners who are in the forbearance program. So it really shouldn't be surprising to see these numbers rise as owners are allowed to defer their mortgage payments. It's not as if they're simply choosing not to pay. And this is something else that gets reporters, quite frankly, in a tizzy. Yes, the delinquency rate is elevated, but it actually fell by nearly 9% in July, and that therefore lowered the national rate to 6.9%. That is better than it was, but I must admit that it is true there are still 2 million more borrowers delinquent now than there were back in February, and that was when COVID-19 really hit the US economy. And when we look at how late borrowers are in making their mortgage payments, well, take a look at the light blue line. That's 30-day delinquency rates. And at 875,000, the total is actually 14% below the pre-pandemic level. Now that tells me one thing, and that is the initial wave of COVID-19 related delinquencies has certainly subsided. In fact, 30-day delinquencies hit their lowest level on record back in July. But I must admit, 60-day and 90-day delinquencies are elevated, with 250,000 more 60-day delinquencies and over 1.8 million more 90-day delinquencies than there were back in February of this year. But again, to put this in perspective, the share of owners who are delinquent on their mortgages, well, it's exactly the same as it was after Hurricane Irma hit back in 2017. And if memory serves me correctly, we made it through that period without the housing market collapsing. Okay, so what kind of numbers are we talking about when it comes to homes in forbearance? Well, this is the very latest data coming out from Black Knight Financial, and it shows the forbearance situation as of September the 8th. In total, 3.7 million mortgages in forbearance, and that's out of a total of 53 million homes with a mortgage. Therefore, it equates to around 7% of all mortgaged homes. And as you can see, forbearance is being quite heavily utilised by homeowners with either FHA or VA loans. Now that actually makes sense, as these loan products accept lower credit quality borrowers, and they are possibly being more impacted by COVID-19 related job losses than others. But what these numbers don't show, and what is not actively reported by the media, is that forbearances are now down by around 1 million or 21% from the peak that we saw back in May of this year. And while 75% of borrowers in forbearance have had their plans extended beyond the initial 90-day period that they were allowed, new forbearance plan starts, well, they just hit their lowest level in more than 5 months, with an estimated 48,000 plans initiated in the first week of September. That's down 16% from the previous week and down by 22% from the first week of August. As you can see here, the number of homes in the programme has been shrinking since early July. After dropping by nearly 150,000 the week before last, the total number of mortgages in forbearance dropped by another 66,000, or 2% of the total, last week. All in all, active forbearances are now down by 238,000 over the past 30 days. And this is because mortgage services are continuing to work their way through the wave of forbearance plans that are set to expire this month. And this chart shows the number of mortgages in forbearance and when those initial plans are set to expire. The numbers are certainly significant this month, and this is something else that has the media stirred up. But it's my belief that we will see around half of the plans extended beyond that initial period, and I expect to see around half coming off the programme. The reason why I expect these numbers to be fairly equally split is that if I look at activity over the last 30 days, well, there's been a roughly 50-50 split between removals and extensions, about 500,000 loans falling into each category. And I do expect to see the same thing when this group of forbearances expires. Now, this last chart shows that out of the roughly 6 million homeowners who at some point entered the forbearance programme, around 2 million, or 34%, have left the programme. Now look on the right of the pie, and you'll see that a full 26%, more than 1/4 of borrowers who were once in forbearance, about 1.5 million homeowners, well, they are current on their mortgage payments again. Now, there were also 274,000 homeowners, well, they paid off their mortgages either through refinancing or by selling their homes. Again, they came off the programme. Finally, another 249,000, while they are no longer in forbearance, but they are still past due on their mortgages. On the left, you'll see that roughly 2.85 million homeowners have had their forbearance terms extended. Now, of course, it is great to see 26% of borrowers who were in forbearance coming out and making up their missed payments. But I will be closely watching the 249,000 owners who are out of forbearance, but who are still past due on their payments, as these are owners who are clearly still in some form of stress. But when I think about these homes, I really don't see them turning into a wave of foreclosures, because we all know the market is remarkably healthy. And even these owners, well, they still hold some equity in their homes. And even if they can't get back on their feet, well, I anticipate that many are almost certain to sell their homes and get the equity out of it, rather than go through the foreclosure process when they might lose that money. So I am worried about 250,000 homes, but let's put things in perspective. During the 2008 housing crisis, almost 10 million Americans lost their homes. And that's a number that dwarfs what is happening today. So there you have it, my update on the forbearance situation. It is bad, there's no doubt about it. There are people who are still suffering through the current COVID-19 related economy. But do I see it as being something which can really hit the housing market hard? I'm afraid I don't get it. Now, what I say, obviously, well, headlines are not interested. In reality, sometimes they are far more interested in making things sound possibly worse than they really are. It is a problem, but I honestly believe over time we will come out of it, and we'll come out of it, relatively speaking, unscathed. As always, if you've got any comments about forbearance, or if you have a topic you'd like me to take a look at, I'd love to hear from you. But in the meantime, take care out there, and I look forward to seeing all of you again next week. Bye now.